Good morning. It is a great day today. It's absolutely beautiful, sunny, blue sky, clear as a bell in Colorado. So I'm Louis Llanes. This is Market Coffee Talk. Hope you have some coffee with you. If not, next time you come on, bring some with you and enjoy yourself and participate. With this streaming service that we have, you can participate. You see how I have a question here? It says, have you learned from your past? You can answer anytime you comment. I can put them up on the screen and we can talk about it in real time. So feel free to comment about any of your thoughts. And I'd like to know, if you are watching this, where are you from and where are you watching from right now? Today I'm going to talk about investing in a rearview mirror. I heard this a long time ago when I first got in the investment business, that you don't want to invest with a rearview mirror view. And I believe it was Peter Lynch, who was the investment manager for Fidelity Magellan, who said that. His point is that just because something happened in the past doesn't mean it's going to happen in the future. And it got me thinking about, when do you know that something that happened in your past you must learn from, and when do you know that you can apply that to today? And there's a real difference between assuming that what happened in the past must happen in the future. There's an old saying, in fact, the regulators in the investment business, the Securities and Exchange Commission, they require you to say in a disclosure that past performance is not indicative of future results. And right now, I think a lot of people are getting kind of schooled in that, because if you look at what's happening in the market right now, what was working in the past is not working now. So I really think that this is something that people need to understand. So what I'm going to do is I'm going to share a couple charts with you. This right here is a chart of some of the stocks in the sectors that are outperforming. What's interesting is if you look over the last year, you really didn't have a whole lot of the last year's winners wind up being this year's winners. In fact, it's very different entirely. What we're seeing is that last year's winners are lagging. So a lot of people, when they invest, they go out and they look at their returns in their 401k or their mutual fund statements, and they say, what has been doing the best? And then they just put money in that. And really what I've been seeing is people putting all their money in one fund. And a lot of them have been Vanguard Growth or Fidelity Growth, and they're all large cap growth investments. So the problem is that the past does not equal the future. So those winners in the past don't work out in the future. So when can you apply that? So let's just use it as an example, what's happening today. So let's look at this chart. If you look at what's winning right now in the market, it's the small caps. Year to date, the S&P 500 is up about 7.5%, but the small cap value stocks are up 18%, well over double. If you look at the mid cap stocks, the mid cap value stocks, they're up almost 15%, 14.95%. And the large cap value stocks are up 12.95% versus the S&P of 7.5. So last year, everybody knew that you wanted to buy growth. And in fact, if we look at the average investor's 401k statements or their funds, the stocks that they own, they're all growth stocks. And they've been severely underperforming now because they're investing with a rearview mirror. Now, we've been talking about how the rotation was happening well last year as it started to begin because the values didn't make any sense. So if you look at it today on the international market, for example, people have been shunning the international market and staying in the US, but guess what? What's outperforming now? International stocks. The international large cap stocks are up 12.36% this year, whereas the S&P large cap in the US is up only 7.5%. And we're seeing that let's just use the sectors as another example. In the sectors that outperformed last year was tech, communications, the growth stocks. This year, guess what it is? It's the energy. Energy is up 32% this year. Financials are up almost 19% this year. And industrial stocks are up almost 13% this year. So investing with a rearview mirror is not smart. So how do you know when you need to make a change? It's based on two things. It's based on understanding what the quality of each individual investment is and the valuation. And if you understand the quality and the valuation of the various individual investments underlying each area, then you can get a clue as to when a change is about to happen. But the change doesn't actually happen until you have a third crucial variable change, and that is the technicals, the supply and demand for the investment itself. When the supply and demand for that investment starts perking up, that's when you know there's the catalyst and it's time to change. We saw that last year. I was talking about it on Real Vision, in interviews in the media, and we saw it slowly develop. So now, what do we make of this? And let's just look at this a little bit deeper now. If you look at some of the stocks that are doing well, let's just take a look at some of the names. The top performing stock, by the way, in the energy sector is Marathon Oil. It's up 69%. And then another company would be HollyFrontier. HollyFrontier is up 43%. ONEOK is up 34% on the year. So you hear everybody talking about Tesla, but nobody was talking about Marathon Oil. Now, in the financial area, the top performing stock in the S&P was the Capital One Financial, COF, a credit card company. That makes total sense. And then in life insurance companies like MetLife, up 30%. And the banks, Bank of America, killing it, up 30%, Wells Fargo, and even the capital markets area, Goldman Sachs. In full disclosure, we own some of these stocks. We own Wells Fargo, Goldman Sachs. So my point that I wanted to make today is that you can't invest with a rearview mirror, and you need the logic and the valuation. So it's a three-legged stool. Quality. Quality is the first stool. What does quality stand for? Well, for us, quality is the knowability of the cash flows. How knowable are the cash flows of that investment? Number two is the valuation. The valuation is based on how much are you paying for this investment given the cash flows that are expected, the growth in the assets, right? And then that's asking the question, how much? And then the last is a technical. Is the stock itself starting to move in your favor? If the stock starts moving in your favor, you have favorable valuation and quality, that's when you know it's time. So that's really all I have for you today. I encourage you to not invest in a review mirror and to have a forward-looking process so that you can have returns that do well over time. Before I close, there's another thing I wanted to mention, and that is that risk management is absolutely key, because when all stocks go down, when the market gets bad, it doesn't matter how great the market is, you got to get out of stocks in order to preserve capital. And you will know that by using risk management. And that means you predefine the amount of risk that you have in each individual investment based on your risk profile, and you diversify across not just sectors or names, but across fundamental drivers. What I mean by fundamental drivers are what are those key variables that drive revenue and expenses and thus profits. If you have those different, and you have diversification in the fundamental drivers, and if you have risk management tools, you should sail right through this, and you're going to have much better results for funding retirement plans and moving forward. If the only thing you can invest in is funds, you have to take a little bit different approach, and we can talk about that in another video. But what you really have to do when you're dealing with funds is that you have to understand that the systematic risk or the overall market risk is higher. Therefore, you have to have a different form of risk management, okay? So that's all I have for you guys today. If you have anything that you want to talk about, you can always reach out to us. You can send us an email at info@wealthnetinvest.com. I'll put that here in the little, so you can see it there on the screen. You can always call info@wealthnet or email info@wealthnetinvest.com, and just let us know if you have any questions. I hope you have a great day, and I'm signing off for now. We'll talk to you later.